right, I'm Jay Shook. Welcome to the Q1 Horizon Advisors Market Review. This is Brad Spindler. So where do we begin today? We've had lots of volatility in the market. We've got a conflict in the Middle East, something that's unusual. Not really. We have lots of volatility in the commodity sector. But what do we want to talk about?
It's a great kickoff, Jay. A lot of volatility in commodity sector, a lot of volatility in the U.S. markets and with interest rates. Started the year, S&P and international stocks were off to a good start. Not so much anymore. As of today, March 23rd, the S&P is down 3.5%. NASDAQ's down a little more than 5%. International stocks are about flat, and bond prices are down to start the year.
Yeah, I'd say, the good news on that is you're getting closer to what we would consider a more normal valuation in the market. We cover that pretty much every quarter. CAPE ratios are down from where we started the year at about 40x earnings. Now we're down to about 37.5, which is not exactly cheap, but something closer to it. I'll put it that way. Obviously, the bond yields is something to watch. What the conflict, I'm not going to get too excited about. There seems to be always something going on in that part of the world, although this one is without question pushing oil prices up, at least in the short run. Depending on when you're watching this, something may be different, but recently we've heard Trump come out and say they're negotiating with Iran. I don't know what that'll turn into. It's why I don't generally make investment decisions based on political events and try to avoid that. But from a long-term perspective, oil prices can, without question, bleed into the economy. It affects consumers. It affects shipping prices. It affects pretty much everything, one way or another.
Absolutely.
But, if we do see a pullback, fear in the market is going to push some people out of it. But the reality is it might just turn into an opportunity.
I totally agree. I like how you touched on oil. I don't think many people realize how oil is in everything, and it can affect inflation, stock prices, pretty much everything. So the price of oil to start the year is at $57. It's now over $100 a barrel. I'm sure you've seen it at the pumps. I filled up today. I paid over $4 a gallon. But if oil remains high for a while, it can bleed into inflation. It can cause consumers to slow spending, and it's a vicious cycle. You typically see oil spike during recessions.
Yeah, we've definitely seen, if you look historically in the 70s, in the 80s, the 90s, even the 2000s, with some of the different events, for the most part, at least in the Middle East, that have spiked oil. And it's not necessarily the cause of a recession, but it does play a role. It's been part of it. So it doesn't mean we're going into a recession, but it may mean it's something to keep an eye on, especially if these prices continue. But that's a big question.
Absolutely.
Yeah, I'd say besides that, the other thing is this spike in oil is pretty significant. We've seen gasoline prices move at a higher rate up than we've seen in about 30 years. So that plays a role as far as the speed of the change. It could also come back down quickly. So if things settle out, it might not be a real long-term issue, but that's a huge unknown.
Absolutely. Oil production in the U.S. is strong. We're still producing more barrels than we're using. But unfortunately, the Strait of Hormuz is closed down, and many countries like South Korea depend on that for their oil. Something to keep an eye on.
What else besides oil? What else are we seeing as a big drawdown right now?
Tech is in a big drawdown. For the first time in 212 trading days, the S&P 500 broke its 200-day moving average. More of a technical thing, but usually when the 200-day moving average is broken down, in the short term, that's not a good sign, but in the long term, it usually represents a pretty good opportunity.
Yeah, I think the other thing to watch, you hit on it early, interest rates. The 10-year is something we've been watching for a while. What I think is unique is today we're sitting around 4.3% on the 10-year yield. It was there a year ago. It was there 2 years ago. It wasn't that far off in October of 2022. The reason that's unique is if you've been paying attention to the news or listening to your mortgage brokers, everyone's been calling for rate cuts for a while, talking about the chance to refinance. I don't know if it's coming. If we look at the bond market today, it's pricing in that there's a higher likelihood of a rate increase from the Fed than a rate cut this year, at least. I don't know what will happen. That's a big what if as well. But nonetheless, it is interesting that we've been probably sitting here, close to 3 years, at least 2 years, talking about when are we going to actually see rates drop, not just the Fed cutting, but actually starting to work its way into things like a mortgage or an auto loan. And we're just not really seeing any big moves there.
No, we aren't.
So I think it's something we'll have to watch. And I like to say rates don't really move until they do. But what I mean by that is some triggering event could drive them down. If we see employment numbers start to get bad, meaning people are getting laid off, that could push rates down. If there's major fears in an economy, that can do it as well. That's kind of the issue, though, is often that's sort of coinciding with bad news.
Absolutely. Another thing I've been noticing in the markets recently, Jay, a lot of talk around private credit and a lot of talk around software names.
Yeah, I mean, the private credit story, I don't know if that really hits a lot of our clients as much as we see it, but it's starting to filter its way into the media. I mean, that's for certain. And it is a concern. I mean, what do you think of it?
Great question. What we have been seeing is that there are funds that are starting to gate. And what that means is these are illiquid funds in nature. So typically every quarter they offer a redemption. If you invest in these funds, you can pull your money out every quarter. But it's typically 5% to 2.5% a quarter. And we have seen more redemption requests than that. So these funds are starting to gate. So what that means is you won't get all of your money out when you request it out. It's a blessing and a curse for these private credit funds because what they invest in is not liquid. So you're investing in private loans. So if they were to meet the demand of all the investors and return capital to them, they would have to sell these loans for not pennies on the dollar, but at deep discounts. And then in the long run, that would also hurt the investor.
Yeah, so to some extent, they're trying to protect the investor, protect themselves. I get it. But nonetheless, liquidity there's a value on liquidity, and we do like that. But right now, it's probably not a major talking point just because I think the average investor probably doesn't have money in private credit. But at some point in time, it can start to filter its way. The effects of that situation can filter its way into the other parts of investments.
Absolutely. And the public equity of those companies, they've been hurt as well this year.
I mean, I think outside of that, the biggest thing as we look forward is really what's going to happen in the Middle East. What are we going to see in the economy? AI is still in the discussion, even though it's kind of been put on the back burner while we pay attention to the conflict overseas. But right now, there's a million what ifs. At the end of the day, you got to have a plan. You got to stay the course. If you do that, you're going to have ups and downs, but it doesn't matter in the long run. You got to be ready to play the long game.
Absolutely. And it feels like we were talking pretty bearish today, but there are some good things going on in the economy. GDP is growing. The GDP estimates are very strong. The energy sector has had a great year. The energy sector is up 30% year to date. Now, part of that is because of oil spiking, but even pre-oil spiking, energy has been doing very well. Same with utilities.
Yeah, it seems a little bit of a balancing out, right? The Mag 7, they've had some years that they were on a good run. Now we're seeing where we see like an equal weighted S&P 500 fund that is outperforming year to date. That may not continue, but nonetheless, we're seeing a bit of a balancing out here in the market. And at the end of the day, even though the market's down a bit, it really isn't that large of a decline, as far as what we see in a typical year. So I don't think it's the end of the world. It doesn't mean there's not going to be more volatility or the market's going to go one way or the other. It just means have a plan, stick with it.
Absolutely. I would say stay the course and look for opportunities in the upcoming future.
All right. Well, other than that, I think we'll see you next quarter, and stay safe.